Hi guys, welcome to my channel. My name's Tim, and today we're going to address one of the big issues with Bitcoin, and that is what causes the Bitcoin cycles. And straight off the bat, I don't believe it is the Bitcoin halving that everybody talks about. I've got another theory here, and I'm so excited to share this information. I think it is the smoking gun. It's basically staring us in the face. There's about 70 years worth of data here that we can use to back up this theory. And I want to show you just exactly what I think is causing not just Bitcoin, but is also causing market cycles every 4 years. I've found something in the evidence. So first of all, what I've got on the screen here, this is Bitcoin. So Bitcoin has only been around since the financial crisis back in 2008, and that is really critical. And I'll get to why that is really critical in a minute. And I mean, we know Satoshi, part of part of their motivation for creating Bitcoin was in response to all the issues that we had through the centralized banks through the financial crisis. So it's no coincidence that that's when Bitcoin started, just after 2008. And it has had an amazing run since then. You can see here it's gone up and down, but overall it's been going up. And I'll give you a video soon about the nature of it going up. And I've got some really exciting insight, and there is some clues on this screen already that those keen viewers might be already seeing. But to cut a long story short, what I think is causing the Bitcoin cycles is something that's also causing cycles outside of Bitcoin, and it's been happening for a very long time, and that is the natural 4-year cadence of the market, okay, of the entire stock market, of all markets around the world. I've noticed there is a 4-year cadence. So check this out. So we're going to go away from Bitcoin for a moment. I'm going to bring up the Dow Jones, and I've had a look at the last over 100 years worth of Dow Jones data, okay? And first of all, you can see the blue line here, squiggly little line, big crash. We had a big period over here through the middle of last century. We had 17 years up, 17 years sideways, 17 years up, 11 years sideways, 11 years up. And this is so much to talk about today, so I won't do it all in the one video, and I'll come back to what these big 17 years and 11 years mean in another video. But what I want to draw your attention to here is this shaded area is the 30-month moving average. And what it does is it really just smooths out the price action. So you get all these squiggly lines, but this smooths it out and it tells you what really is happening over a long period of time. And when I overlaid that over here, I noticed that, especially if you start around here, 1950, you notice there's a cadence here, and I've measured these. It's almost exactly every 4 years to the date. Excuse me. So every 4 years, by the way, there's a massive crash down there, and I can, again, I'll show you a video about where that crash went to, where that crash went to, where this crash went to, and how we can potentially predict further crashes. But I'll come to that in a future video. There's too much to talk about. The important thing here is every 4 years, there is a natural cadence. It bounces. It's been doing it for 70 years. It's almost to the date. And right now, let's zoom right into the current. Actually, this is the zoomed in period back from around the 1950s. So you can see here it bounces off it perfectly. So this 30-month or 2.5 years, whichever way you'd like to call it, this moving average, the price action bounces off it nice and healthily, okay? Now, if we go back to the Great Depression years, and I'll produce a video on this, it didn't do it back then. You can see here it actually skipped a beat. It went up too high, and it crashed right through. And I'll produce a video about that. There's so much more detail, and there's so much more to it. But really around 1950, that's when things really started to get on track. And ever since then, it's actually been a pretty steady increase, then sideways consolidation, increase, sideways consolidation, increase, What's going to happen next? Again, I'll produce a video on that also. I think we can predict some of these things to some level of detail. So anyway, this 4-year cycle, what's interesting about it is that the 4-year cycle happens to happen on these particular dates. Now, I like to think of this as the Olympic dates. Now, I know the Olympics for 2020 was postponed to 2021, but throughout the last 100 years, the Olympics have always occurred every 4 years. And I've noticed that these dates all line up. So this is a close-up again here of the Dow Jones Industrial Index. I know I'm covering a lot of information here. I'm just so excited. I'm going to go into more detail about a lot of these topics in separate videos. But for those who don't know about the Dow Jones, and I know a lot of people in crypto like to stay in the crypto bubble. And there's 2 crypto bubbles. There's the price bubble, and there's also the information bubble. And the fact that crypto is an asset, but it's part of an overall market. It's just one asset within an overall market. But a lot of people like to stay inside the one asset. But for those that don't know what the Dow Jones is, it's basically an index of the top, I think there's about 30 companies in it. So the top 30 companies, they're all the top blue chip companies. You've got, Apple, Boeing, Microsoft, Coca-Cola, the companies that survive over the long term. So it gives you a really good indication of what the market or what the strong parts of the market are doing. So so the market basically, the Dow Jones, you notice this, it always bounces off the 30-month moving average every 4 years. And you can see here, you can even predict some of these crashes. Now, it doesn't always crash through. You can see here in 2008, it crashed through. It didn't just bounce off like it has over here. It actually crashed through. And again, I'll produce some videos on that. And, the further it overextends, the further it can crash. And there's two ways to crash. There's either crash back to the average or go sideways, and that's a time-based correction as opposed to a price-based correction. I'm going to cover all these topics in much more detail. This is just a very quick overview, of Bitcoin. So I'll get back to Bitcoin in a minute. So anyway, you can see here, once it bounces off, that kicks off the momentum for the next 4 years. And the price, the prices go up, the index goes up, and then it comes back. And this is healthy. And we saw over that 1950s period that this is healthy. It goes up and comes back. That just lets it go in the long term. And you can see here it had to go sideways for a while. That was a long time. But when it bounces off that, it's nice and healthy. We want that to occur. What we don't want is what happened in 1929, where it just went up too high too fast and then crashed down and so forth. And we had a similar situation here in 2008, where it went up too fast with the dot-com bubble and then crashed back down. So we want to avoid those sort of boom busts. Okay. Now, the interesting thing is Bitcoin started around here. So Bitcoin has had the perfect run, and we're going to cover that as well in another video. Okay. All right. So what my theory suggests is that the overall market bounces every 4 years on the Olympic years. Okay, so 2008, 2012, 2016, 2020, 2024, 2028. Now, we should be able to predict with some level of certainty that 2024 will be a date that we bounce off again, and then 2028 will be another one, because it's been doing this for the last 70 years, okay? Now, it is possible that we have another massive, Great Depression, a massive crash and so forth, and that might mix things up for a while. And again, I'm going to cover that in another topic if that does happen. But this is what we can see. Now, what I've done here, let's get back to Bitcoin. I've got the free version of TradingView here. I've got no viewers on my channel just yet. If I make some money or with the channel, I will buy TradingView. So here, these dotted lines here, the red lines, these are the Bitcoin halvings. Okay, so a lot of people see this and go, "There's a correlation. Gee, look at that. There's a line. That's when the halving occurred, and then bang, Bitcoin goes up. There's a Bitcoin halving, bang, Bitcoin goes up. There's a halving, bang, Bitcoin goes up." And correlation does not necessarily equal causation, okay? So a good example of that is there might be a correlation between ice cream sales and crime in a city. So when they see the ice cream sales go up, the crime in the city also goes up at the same rate. And then when ice cream sales go down, crime goes down. But maybe it's something else that's affecting both those factors. Maybe it's the weather. So when the temperature goes up, people buy ice cream, and people are also out in the street causing crime. When the temperature goes down, people are not buying ice cream, and people are not on the street, and the crime goes down. So maybe there's something else going on here. Now, we've only got 3 Bitcoin halvings to work with. And yes, Bitcoin has always gone up after a Bitcoin halving. What makes me skeptical about the halving is, like, I like to invest in crypto, and to me, it has no interest. The halving, does it create a supply shock? I don't know. There's so many with Bitcoin. There's something like I think 19 million Bitcoins that have been in circulation. You know, some are held by long-term holders, and there's a certain smaller percentage. I think it's about 10% that's actually liquidity, that's actually being traded. But I'm not getting out of bed because they're halving mining rewards. It doesn't really interest me. I think what is more likely is that the natural market cadence, which has been going on consistently since 1950, okay, and it probably would have gone on before that, but it was, the 1929 crash made it really disruptive in those early days. So for the last 70 years, we've had a cadence every 4 years, and I've put those dotted lines in recent years. So the dates here were September 11, 18th of September 2011. We've got another date here around sort of January 4, I think it was, and then another date here. So I've got it marked there, January 29, 20 September. I've got the dates in here. It's 15th of March. Those dates also correlate with Bitcoin going up, and they also correlate with the Dow Jones going up. And I checked the NASDAQ as well, which I haven't got up here on the screen. The NASDAQ was not as exact. It was staying above the average, but it was coming down every 2 years. So it was bouncing every 2 years, or sometimes every 6 to 8 years. So it's still in that similar cadence. So anyway, I'll finish the video there. That's my theory on Bitcoin and what causes the Bitcoin cycles to occur. I think it is, based on all this evidence and the trends, it is 4 years, and it's not 4 years because of the halving. The halving happened to be around here, and Bitcoin started at the 4-year mark. So it's like a perfect storm to all happen at once. But it's the natural cadence of the market, and Bitcoin is one asset within a larger market. So I hope you enjoyed that video. Please like and subscribe and all that sort of stuff. And I can grow the channel. I can produce more content. There's so many topics I want to cover here, and there's so much detail that I want to get into regarding Bitcoin, crypto in general, and just the long-term market trends. We can learn so much from history. Those that don't learn from history are doomed to repeat it. That's a really great saying. And another great saying I love is that this time is different. So everyone thinks this time is different. And I'm going to cover all that in future videos. So until then, thank you very much, and I'll see you in the next video. Cheers.